And welcome to In the Room with Laurium Capital. We're here with Murray and Dwayne. Welcome, guys.
Thanks, Steve.
Yeah.
Hi, Steve. Nice to have you in our offices.
Yeah, exactly. It's great to actually be in your offices. I'm Steve Backhouse. Often forget to introduce myself. I think today is our 12th or 13th In the Room. I think one of the things when we launched the In the Room kind of webinar series and concept was the whole idea was actually to come to the asset manager's office and sit and talk to you guys and get a feel for the business. I think this is only the third time we're actually able to do that. So it's great to be here and thanks for having us. Before we get going, just a couple of house rules as always. So it's a 1 hour interactive webinar. We try and make these webinars as interactive as possible. So for the audience, please post your questions via the Q&A tab. What we'll do is I'll chat to Murray and Dwayne for about 20-25 minutes or so. Then we'll have a break. We'll have a look at the questions, see where those take us, and then we'll carry on, and then we'll close at 10:30 sharp. As always, importantly, CPD points. So CPD process is if you attend the full webinar, I think 95% of the webinar, you'll get allocated your CPD point automatically. If you aren't able to, then you can do a short assessment and then you get your CPD point. That's about it from the house rules. So first off, as I said, nice to be in your offices. Nice that you guys are in your offices. Murray, I walked around earlier. You're in your offices, but it's also fairly quiet and sparse. But I'm sure it's important that you guys are back in.
Yes, we've been quite, Steve, thanks. Yeah, we've been quite careful, I guess, over the last sort of 9 months. But we've generally had about 60% of the people in the office. We rotate around. We have offices, Joburg, Cape Town, and we have 2 people now in London as well. And it's important to get people in the office, obviously being pretty cautious. But so on a rotation basis, pretty much. So we'd have on average sort of 50 to 60% of the people in the offices. But the energy level it creates from being in the office, the interaction is just, for us, we find pretty important.
Yeah. Yeah,
maybe I can add to that. It's just the collaboration between teams fantastic once you're in the office space and feeding off each other and, bouncing ideas off each other. And that really helps. So while we were constructive, while we were in full lockdown, we were all at home because we've had this video wall that you've seen in our office. Yeah. We've had that between the Cape Town and Joburg office for ages now, which has really worked well. And so we've been working through Zoom for ages. So even when we work at home, we're all sitting on Zoom and we can collaborate. There's just a different energy when everyone's in the office, which is great.
So for audience at home, the video wall, it's quite interesting as again, I walked past it and there's some big screens up and I literally got the cameras on in the London and the Cape Town office. So I think it's as simple as you can walk up to the video wall and go, hey, so-and-so, let's have a chat, and they can walk up and chat to you. So it's almost like a virtually being inside your London and your Cape Town office and vice versa.
That's exactly right.
Yeah, which is, I think that's really, and that's pre-COVID, eh?
That was pre-COVID, yeah.
Yeah.
No, it's important to have that connection with people, we find. And just particularly youngsters, creates a bit more energy. And as you say, it's quite nice going up to the wall. You can turn it off and not to hear the other side, but you can just quickly, if you want to get a hold of something, press the button and automatically you're talking to the whole Cape Town office. So it creates a little bit of energy.
Yeah, I think it's really cool. Murray, you're co-founder of Laurium. Maybe take us through kind of the journey and the growth that Laurium's been on and you've been on.
Okay, well, I guess it's quite a while ago now, sort of 12 and a half years ago. Gavin and myself started Laurium, started running our first funds, hedge fund business in 2008, in August. Bad timing, not very clever. That was 6 weeks before the Lehman's crisis, so we just got going. We started with just over 100 million rand from 12 individuals, actually. And then we were planning to raise from institutions as well, but we had Lehman's came along, and I must say that it was quite a hairy moment. And for the next year and a half, it was really just heads down, trying to generate some decent returns, which we managed to do. And then
like quite an interesting and steep learning curve to be going on your own. 6 weeks later, GFC hits. I mean, as you say, like that's, and I mean, I know of some hedge funds actually, I think across the road here, they actually closed their doors at that point in time.
Yeah, no, there were a couple that shut. What we did do, in fact, two of the individuals who work with us now, Paul and Kevin, were working for another hedge fund, and they shut down early in March. It must have been March
2009.
2009.
Yeah.
And we said, well, listen, we'll take them on. Another manager said, look, and at the end of a six-month period, we'll take one of them. We'll keep one of them permanent. And so it was maybe a bit stressful for the two of them. Anyway, we decided that they're decent guys, so we kept both of them. So they're still with us. So one's Kev, who was an analyst then and now head trader, and Paul Robinson, who has also done quite a lot of experience, and he now runs on the Africa side. He's head of Africa research and one of the co-PMs on Africa. So it was a hairy times, but we all, Gavin and myself, all having come out of sort of investment banking background, said we'll give it 2 years. We can happy to fund it. Pretty hairy, and from there we sort of managed to do. The returns were decent, and the business steadily grew. So we now, as a business, just as a reminder, I mean, we up to 35 billion of assets. We have spread of that. We have 45% of our assets come from offshore. We have 55% in equities, multi-strat funds that we sit with some 20%. Hedge funds, where we started, is still 10%, and Africa is about 10%. So pretty well diversified business. We have 30 individuals in the 29 individuals in the organization, and we have 14 on the investment team. So yeah, we've steadily grown, and fortunately the returns over time have been pretty decent. And yeah, that's 12 done.
Quite lots
more to go.
The thing that stands out for me there is it starting as a hedge fund business, but obviously now a lot more diversified. Like that's kind of which is important in terms of running a business, I presume.
Yeah. So I suppose building the business. Some of the asset managers, when we started out the business, thought, look, Hedge was a pretty exciting place to be. I mean, you can go long, you can go short, so it's a lot more fun, I think, than pure long only. But in terms of in South Africa, the hedge industry globally is about $3 trillion. South Africa, it is probably 50, 60 billion rand.
Yeah.
Just hasn't grown. So after a few years, I mean, I guess 8 years ago, we branched into the long only space and said, we're doing all the work. Let's start in the long only. We started with a flexible fund initially. And then we moved into a pure equity fund and Africa funds, etc. But yeah, so we built a business over time, added individuals, and so I think it does strengthen, the business, doing diversification.
Probably nice time to bring Dwayne in. I mean, so Dwayne, you on the equity side joined in 2015, I think it was. I mean, what can you add to what Murray's saying, particularly around the culture of the business? So Murray's obviously kind of the co-founder, has been part of the whole time, and you coming in, tell us how you're feeling on the culture of the business.
So, I mean, for me, it's been 6 good years at Laurium. At the end of the day, asset manager is all about its people, right? And the one thing I picked up when I joined Laurium was the people here are really passionate about the markets and live investing. So that's really important, step one. I mean, Murray mentioned they came from an investment banking background, so that DNA is in the business. So very opportunistic. We can move quite quickly. We're nimble. We've got quite a good African team that covers the whole African continent. So there's a lot of collaboration between South Africa and African team. A lot of South African stocks have exposure to Africa. So that's great. The team comes from different backgrounds, so good network, which obviously goes into your investment process. And then a rigorous and well thought out investment process and philosophy that we've stuck to and have resulted in good returns over time. So it's really been a great journey and learning experience for me over this last 6 years.
Yeah. 6 years doesn't feel like it.
No, it doesn't. Time's flown by.
Yeah. And just, I mean, another question is you see 35 billion, you are a boutique asset manager. I mean, do you think that gives you an advantage over some of the bigger guys?
So, I mean, I do. I mean, if you were to just look at the market, for instance, if you had 100 billion rand under management, I mean, if you looked at the Aussie, there would be about 7 stocks where you could get a 3% position under 10 days if you're a third of the trade of the market. So I mean, that gives you a feel for it. And I've just seen from experience, I've been at a big asset manager, I've been at other boutique asset managers. My experience coming to Laurium is that we have been very nimble. And even stocks I cover, we've really been able to take advantage of dislocations in pricing when we think the market's moved away from what we think is the fundamental fair value of stocks, which has been great and presents great opportunities.
Yeah. Okay. So I think it's worthwhile getting into actually the topic for today. So the topic today is the new dawn, a new dawn for SA markets. And I think, a lot of people I chat to they've seen the equity market run quite nicely this year, but there's still a lot of that negativity in the press in particular. And I think about the guy on the street, that's what he reads. He reads the newspaper. And cool, the market's running, but geez, we've still got this COVID thing hanging over us. We've got a lot of the kind of the political, what's the right word? I'm not sure, what I mean? Uncertainty, exactly. Thank you. Yeah. And but Murray, is this a new dawn for SA markets?
The markets is interesting for the countries, probably slightly different. But I mean, a new dawn. If you say to me what is new dawn, I would say democracy, 94. Huge new dawn, big growth, fundamental structural changes, etc. And we really rallied very strongly. The economy, in particular, growth for the people, and markets did extremely well. Then we got into the Zuma years, I guess, which was pretty bad. Prior to COVID, the 5 years before, economic growth was below 1% a year. Very, very, very tough, trying times. Then we got Cyril pops in, and he comes in December 17. The market rallies for 4 months very strongly, all the domestics. We're up 40%. People believe, okay, this is all exciting, big change happening. And it's been pretty tough for Cyril. He's slowly making progress, and we've seen a lot recently. And then he gets clapped with COVID. And COVID, I think, unfortunately, we go down 7% in growth last year, -7. Globally, to put in perspective, the world was down by 3% last year. So we go 7% down. We aren't able to do as much fiscal stimulus, even though we did some monetary stimulus, and we bounce back now. So the bounce back's been huge. And there's nothing like markets rallying strongly. I mean, put in perspective, just as a reminder, if we look in March last year, the rand dollar was at 19. Today, we are at 13.85. I mean, that is a hell of a move. And there were people trying to get money out of the country, if you go to April last year, in a big way. If we speak to some financial advisors, a lot of people taking money offshore. So we've bounced back very strongly. Markets have also, obviously, when it was things weren't looking pretty rosy, middle of last year. Markets, the South African market in rands is up 75% from its bottom. In dollars, it's up 115%. I just looked at the stats this morning just to make sure it's up to date. 115 in dollars you've made if you from the bottom of the market. So what it says is when markets get smashed, don't get out of market, don't panic. So that's what's happened. Now, economically, the big fiscal and monetary stimulus, global growth this year is probably going to be close to the 6% level. So it's big. And for next year, 4%. So the world is looking pretty rosy. We have vaccines being rolled out. Confidence is good. Reopening trades. So it all feels quite good, particularly it's probably more for the haves and have-nots because the people invested in markets who've got surplus capital doing all well. The COVID vaccination rollout is going to be good for people anyway, but there's a long way to go. So it's all feeling quite good. And we think that momentum for South Africa with the resources rebound, which is phenomenal. So we've got a trade account surplus now coming through this year, which is unbelievable. Our budget deficit is going to be a lot better than originally thought. And growth for us this year is probably, we thought beginning of the year 3.5. Right now, it looks like it'll be up at 4. So that's all positive short term. And that momentum, I think, we think that continues. The big problems are longer-term structural issues. So when we talk new dawn for markets, so right now it looks good, and with that momentum, we think continues. Longer-term, the structural issues for SA in terms of the unemployment, creating jobs, our SOEs. Those are big structural things. The key man risk was Cyril, which, I mean, is a big issue. The next election, does he get a second term? I mean, if you look at the political analysts out there, there's a sort of 75% chance he gets in it as a second term, which I think is very, very important for SA. And he's slowly gaining power that he's able to do a lot more. But it's not plain sailing. So at the margin, things are really good at the moment. Longer term structural issues, we've got quite a bit to do to get things to work. But we have a setback. We have 85% debt to GDP. We have high interest rates. We have big unemployment. So it's going to probably be big bounce back now and very quite modest growth. But there is a chance if we have some structural reform that things could be better. But for now, markets look pretty good. That momentum, I still think, recovers as global growth is the primary driver of benefit South Africa.
It's almost like you got to, so you say like, it's almost like you got to take advantage of this momentum at the moment, but what's key is these structural reforms coming through.
Yes. Maybe I can add to what Murray says. The question we always ask ourselves is what's priced into the South African market kind of thing. So there is structural issues, but there's pockets of valuation that look very attractive. And there we're finding great opportunities.
Give us an example there.
So, I mean, we've liked MTN. That's not totally South Africa, but that looks very attractive. Something like Netcare in the healthcare space, we think looks fantastic. I mean, it's trading on a 7 EV/EBITDA. The main thing there, we think that elective surgeries come back. And so the capacity utilization in the hospital picks up and you get a lot of operating leverage there. So the earnings grows back and it's not highly geared. So even with the current depressed EBITDA due to a COVID base, it's a 2 times net debt to EBITDA. So it can carry on operating even through, let's say, a third wave.
That's also, so everyone kind of logically thinks COVID, people are sick, hospitals are doing well, healthcare doing well. Actually, what I've heard from people who've gone in, actually the hospitals are dead, they're quiet, they're struggling, because they don't have the elective surgeries and things like that.
But it's interesting. So in the first wave, Netcare reserved 80% of their beds for COVID patients, and those beds weren't filled. So obviously, if it's not filled, then the hospital doesn't do well. In the second wave, they managed it better, 60% of the beds for COVID patients and the rest for elective surgeries. And there, the hospital was actually relatively well used. And so for the third wave, I mean, they've just come out with the results. It looks like they're going to be able to manage it relatively well. And so you should see that capacity utilization, let's say, back above 60%, which would be very positive for the results.
Okay. And you mentioned MTN. I mean, why do you like MTN?
So MTN, look, we've liked for a while. I mean, it got very depressed, right? There was a lot of forced selling that put pressure on the stock. That was during sort of, March last year, when the COVID warrior, April last year, when the COVID warrior is at its maximum. And I mean, at that stage, it was trading, basically, you were getting the Nigerian operation for free, basically all the African operations for free and paying a cheap price just for the South African operation. Subsequent to that, the new management team has done a great job. We think they're going to unlock a lot of value by selling things like the South African towers. They list the Nigerian tower business, IHS, and there's a whole bunch of non-core assets they're going to sell off, which is fantastic. And the underlying business has actually benefit from COVID because people are using more data. So it's growing very nicely. And to overlay across all of that, it's trading at a very cheap multiple. So a 4 EV/EBITDA, which for a telco, compared to its history and or other telcos, something like a Vodacom's at a 6.5 EV/EBITDA. So we think there's a lot of value in the stock, even at this point. It has rallied hard. We still think there's very decent upside.
When you say sell the towers, you're talking about the cell phone towers in our suburbs, as an example.
Correct. So, I mean, a lot of people are doing a tower deal. And the reason for that is if you look at a tower co, people put together a company where they put the towers in, they get much higher valuations. And I mean, they can trade, in the States, they're trading at 20 EV/EBITDA. Now, I'm not saying African telcos can trade at that multiple, but even if it was a 10 EV/EBITDA from where MTN's trading currently at a 4 EV/EBITDA, you can unlock quite a lot of value by doing that. So you see Telkom's talking about it, MTN's talking about it, even Vodacom's talking about it. Vodafone in Europe has actually just done it and formed a tower co. So I think that will be the way. And I mean, telcos, and then on top of that, they're talking about unbundling mobile money, which is another attractive opportunity. And I mean, that gets a higher valuation. They all own a lot of data centers. The data centers get higher valuation. So if you look at the sum of the parts of MTN, we think there's a lot of value in that stock.
Yeah, we actually had a call with Tom Walker from Schroders, and a big theme was about data centers. In his,
really?
so he runs a property fund, which is quite different to your normal property fund. And I think his saying was data centers are the new beachfront property was the saying, which is quite interesting.
Well, I mean, it's really driven by edge computing, right? So if you can get the data center closer to people, it takes less time, and you store data there. It takes less time for them to download the video, etc. Yeah. So everything's going to edge computing. So the more data centers there are close to urban areas, I mean, the more powerful.
So exactly, you're talking about having the data centers in New York.
Correct.
Which was fascinating.
I mean, just from a price point of view, it's quite. I mean, MTN was down at 30 Rand in the crisis. It's now 97 Rand today. So it's gone up from 30. You've gone 100%, 200, more than 200% up from where it was. So there were some really scary opportunities a year ago.
Yeah, that's in actually a relatively short period of time. Yeah. So it's 12 months, just over.
Yeah.
So, No. You spoke about unbundling. Naspers has been in the news a bit about their unbundling. Can you maybe try and unpack that for the audience a bit?
So first and foremost, if you look at our Naspers investment thesis, it's really driven by an asset called Tencent in China, which is 85% of the value of Naspers. And we think it looks extremely attractive, but that's a totally different, I mean, there's a great investment thesis behind it, and we think that's a great asset. Our theory was, or our investment thesis for Naspers, which trades at a 50% discount to its underlying assets, which is very large, was that they were going to unbundle some of Process to you as a shareholder, and they were going to take their own 73% of Process, take it out to 50%, and that would close your discount on your Naspers shareholder, on your shareholding, because Process trades at a narrower discount, 36% odd. What they've now announced took us by surprise, and they've basically said that Process will issue shares to Naspers shareholders for 45% of their shareholding in Naspers. So as a Naspers shareholder, you own one Naspers shareholder, you're going to give away 45% of it sell 45% to Process, and Process is going to give you a Process share for that. Yeah. They're giving you a slight premium there, so you make about 7% on the trade if you look at where the shares are trading at the moment. And there's a bit of a NAV per share pickup because you're issuing a share Process which trades at a narrower discount, and Naspers trades at a wider discount, so there's less shares in issue. So the NAV of the company stays the same, but there's a NAV per share pickup about 6%, which is positive for all shareholders. It's shared.
So I mean, it's quite a lot of moving parts there. So for guys who are in, say, for your fund or other funds or hold the share, I mean, what does it actually mean for them? It's a positive because you're getting it at a premium and there's
correct. So it's a positive, but we were expecting more, to be dead honest.
Okay.
We thought they could unlock more value by that Process unbundling. Subsequent to that, they've said that there would have been a huge tax bill if they had unbundled to Process, which could have been obviously value destructive. So that could be a worry. This is a tax efficient way of doing it. I mean, we would think there were better solutions, but speaking to investor relations and management, I mean, they've done a lot of work around it and think this is the best solution for the long term. I mean, we think that's debatable, to be honest. Yeah.
Okay. Just a reminder to the audience, just to pose any questions via the Q&A, because we really would like to pose this to Mario and Dwayne. So shout if you've got anything. Okay, so I do want to just jump to another question I had for you, Murray. Again, something you spoke about earlier. So you said you launched your Flex fund in 2013. Now, I mean, again, that's quite a shift from kind of going from the hedge fund into kind of long-only space. I mean, why did you choose to go kind of the flexible fund versus kind of sticking to kind of your knitting in terms of the hedge space?
Yeah, so I guess it was linked to where did we think we could grow. So hedge assets didn't look like they would grow that much. So we're doing all the work, buying stocks. So we said, well, we can create of our long book, we can create a portfolio and just go and do sort of buy a long-only equity fund. And then we thought a pure equity fund, you would have to be fully invested, 95%. With our hedge fund sort of backgrounds, we thought that it made a lot more sense to go into the flexible space, which means, what it means is if we wanted to run 0% in equities in that fund, we could do that. So we could, let's assume we wanted to run cash and equities, we could be not cash at one stage, and we could be 100% cash. That gives us the flexibility. Now, we're not going to run it like that. So we said, let's give ourselves flexibility. And what we've run with that fund since inception is broadly about 80% in equities, fully invest over time. We've been as low as 60% is the lowest we've been in that fund. We do a bit of offshore, we fixed income, we've been into that, we've been to preps. So it just means we have more options on how we can make money for clients. So we said it's an equity-like fund that you'd expect returns similar to Aussie over time, or better, hopefully, and a CPI plus 5 mandate. So that's what we set ourselves out to do. It's done better than that. It's actually grown at 12% compound per year for net of fees for eight years, well ahead of the Strix, probably about 4.5% above that. And it's against the CPI target as well. It's 2% compound per year better. But yeah, it's a flexibility. Later on, then we went into pure long-only space where you can gather a lot more assets because flex is quite a small space. But to us, that was followed on from what we were trying to do in our hedge. Kim actually joined us. Kim Zietzman joined us. And she came in, why did you go in here? Literally is probably 7 years ago. Said it's a wrong category. Said it just sort of made sense for us. We thought we might be able to make more money out of that over time. So subsequently, she said, no, well, this is the categories. And over time, we've rolled out into other areas.
Okay. So I mean, just in terms of, so you obviously need quite a divergent skill set and different expertise to run a fund like that. How do you, I mean, what is your asset allocation process? And you obviously quite confident you've got all the skill set in the team to run that fund in the different asset classes.
Yes, I guess look on the backgrounds, one has come from, from the investment banking side, I take myself from equities, running research in equities, and then running debt and equities for Deutsche Bank. So both sides. Gavin's also in structuring a lot of things there. Then as we've added the team over time, we've had different individuals. We've had Melanie who's come in, who's on the fixed income side. Yeah. So we have an asset allocation for our balance funds. We have a process on that. We have sort of our quarterly meetings, and then in between we can be opportunistic because we're small. So we set a long-term strategic asset allocation decisions on our high equity or our medium equity. And then that's sort of our own benchmark, how we measure ourselves. And then relative to that, we will sort of more in the shorter term decide, do we like equities? Do we like bonds now? Should we cash?
Is it a team? Is it a kind of a team committee kind of decision, the process?
We have an asset, so Brian Thomas so on various funds we have different managers. So it is the asset allocation for sure. Is Brian chairs that, lots of discussions, and then we sort of agree together from that meeting where should we be. Obviously the different funds, if it's a high equity fund, it's Gavin, myself and Brian run that fund. So basically if we look at the low medium equities, Rob Ollerman's in there. Mel gives input. She runs our fixed income. She will give input as well. So a lot of discussion, a lot of different views, and then we sort of get to what we think makes the most sense. Yeah.
And I mean, Joanne, you obviously come in from an equity, very strong equity perspective. We do have a couple of questions actually from the audience. We've got 3 so far. So the first one is around property. Happy to answer a question around property. Yeah. It's always a question around property. Every single webinar I do. It's from Robin. We've seen a nice bounce back since November in the SA property market after a long period of strain. We're expecting a prolonged bounce back. Are you expecting a prolonged bounce back, or are you still cautious on the sector? So who wants to take that?
Okay, I'll take on the property, and then Dwayne can add in if there's anything on top. But look, property was the darling sector for many years, up until probably 3 years ago. Big issues in property. And then globally as well, there've been some very big, with what's been going on, the retail trends out there, and then COVID, which has totally had a big issue on property, on office. So structurally for South Africa, long-term problems in the office space, and retail will have some big headwinds. So that's where we are. The issues on valuations. And so basically we own, I guess, 2 property stocks across our funds, and that is Growth Point, which we think is the best, really strong management teams. Valuations look good. It's trading on a forward dividend yield going forward of around 10% or so, 10, 11%. even if they just pay out 90% of what they earn. So we still like that. It's very linked to the long bond yields, and long bonds you can get 10-year at 9.5%. So your discount rate's quite high. So it looks decent, but we don't think it's going to zoom away. Year to date, I think the property sector in South Africa is up about 18%. So it's done pretty well. Yeah. And as so rightly saying, from November last year, it's even better. So it looks decent. And we have about 2.5% across our funds in that. And the other one we have is some UK property is Hammerson, which hasn't been particularly good. But with the reopening trade now, that should do quite well. So the bottom line is, in property as a whole, South African property, we underweight. We'd rather have bonds, which look very attractive. Yeah. And then there are a lot of, as Dwayne mentioned, we've got quite a few stocks that look quite interesting. The banks, the insurers look very, very attractive at the moment. They haven't done much, particularly in the last sort of 6 months. And even the banks, which the returns, we think, total returns over 12 months, you're probably looking close to 20% we can still get from banks, which have lagged. So, yeah, relative property looks okay.
Yeah, no,
it's not great.
As I say, it's a question we always get. I think it's because it's people kind of see and understand, think they understand property, and it's done so well in the past. And then it obviously got clapped.
Yeah.
And actually took a bit of a smash before COVID because of some of the governance and structure issues.
Governance issues were huge. A couple of property stocks that were really, say, sort of enhancing the earnings they were producing.
Yeah. Anyone you want to add to that, Dwayne, or can we move on to the next question?
No, I think Murray's covered it well.
Okay, they're happy. Okay, so another question. So this is an interesting question. It's from Anonymous. When has your process failed or just not worked for you and you've had to review it? It's a good one. I like it. It's like, what lessons have you learned through your kind of investment process? Again, it's probably a Murray question, Dwayne, I'm presuming.
Okay. For Laurium, we're saying, when has our process failed? Look, I think we've got over all the years, we've built a pretty rigorous process. We get firstly, we get a lot of things wrong. We have our process with lots of different views, and we get a lot wrong. Going into the crisis, in our hedge funds in particular, we were pretty long in equities and quite high beta. And we also, in our fixed income, we had quite high duration. We discuss things, we go through the process, but it doesn't mean you get everything right.
Yeah.
If we can over time get 60% right, we're going to be in the top quartile over time. That I'm very confident about. I think that when you go into the crisis, there's a lot of debate around that time. I think from a process point of view, went in too long, a lot of debates, what we do, how much ammunition we had. We did switch a few things at the bottom of the crisis, probably with hindsight, not enough, but we came out of the crisis pretty well. We kept our equity holdings. We did not sell down equities at all. In our hedge funds, we trimmed a bit early on, but then we were too long. But we added a little bit at the bottom, not as much as we should. But I think our process was pretty robust. I think the uncertainty was quite scary. Yeah. So we stuck to our view we remain invested. We've been totally surprised how rapidly the market has recovered. But I think from a process point of view, we always try and refine. We did a deal, I guess. We brought acquired Tantalum in November last year. So Rob Ollerman's come in, been around for 30 years in markets as well, and a couple of people from the team. So, and we're not too different how we look at things together. But there's always opportunities to refine it, improve it. But I think it's pretty competent process. Always a bit of room for improvement, but I think it's been pretty decent over time, our process. Yeah.
So what I'm hearing you saying is that the process, it's all about refining the process, learning as you go. So absolutely, you're not going to get everything right. That's not the game you're in.
No.
But exactly, if you get it right 60% of the time, you've actually done well. And as kind of technologies and learnings have come through, the process is refined.
Yeah. And just so what we fundamental bottom up as a business in terms of sort of, I guess, 70% of what we do is bottom up fundamental stock picking. And there's sort of a macro overlay with sort of 20%, and then probably 10% would be sort of special situations, event-driven opportunities, just that's what we do. And then it's just how you do that in the process, but very, very detailed process, how you get to pick stocks, what have you. But again, to say the industry gets a lot of things wrong.
Yeah.
But 60% is what we're aiming for. I don't know, Dwayne, I mean, you've worked at a couple of other houses as well. I mean, you want to add something?
So when I joined here, the process was already very robust, but I think it's reiterative. So we are improving it all the time, kind of thing.
Yeah.
And so the process has definitely improved over the time I've been here. I mean, is it drastic improvement? No, but it's at the margin, getting better and better. We're learning all the time and improving our process. But I mean, core to the process is the philosophy, right? And that hasn't changed a lot. So that the core philosophy we stuck by through thick and thin, through crisis and outside of crisis.
Yeah, and I suppose that's so important because again, as you say, you go through kind of March, April last year. It's tough times. You question yourself, but if you go back to kind of your philosophy, why are you doing it, how you do it, and you stick to your guns, you actually get through it.
Correct.
And if you don't do that, then actually it's probably when you get yourself into a bit of trouble and your investors into a bit of trouble.
Sure.
Yeah. Another question. In terms of offshore exposure, so Dwayne, it's probably equity offshore exposure might be for you that you have in your multi-asset class funds. Where are you currently finding value? So I mean, I think it's kind of where you overweight in kind of your.
So when it comes to offshore exposure, I'm looking at the SA equity market, a listed space here. But I mean, within that, we still things like Naspers look very attractive. That's offshore exposure. British American tobacco, we think looks very attractive. I mean, when it comes to the multi-asset funds, I mean, that's probably a question more for Murray, and Murray can speak to the offshore exposure they've taken there that mimics some of what we think is attractive from a South African offshore exposure as well.
Yeah, so from our probably the starting point is equities. So equities have been, we've been overweight in our multi-asset funds, overweight equities. So if we just take a high equity fund, we run over time a 70%. Max you can run is 75. We've believed over time you run a high equity and 70 is our base case. And we're running about 72, 73, pretty full on equities. If we look at our offshore component then for our funds, we're running, I guess we exclude Africa, which is a separate bucket, but we're running at about 27%. And again, over time, we run pretty close to 30%. So SA looks pretty decent. With the Rand, what it's done now, it's starting to look a little bit more interesting on the offshore side. We're just having a discussion this morning in our morning meeting. So this Rand, there's a lot of positive momentum factors at the moment, but listen, below 14, maybe we get down a little bit more, but just how far do you actually stretch the rubber band now? From 19 down to 1385, do you get to 1350, 1325? But you need to be thinking a lot more in the slits pushing offshore. But we still find on the local side, I mean, I think as mentioned in the insurers and the banks, which have done okay, but I think they can still do quite well if you compare it to something like the S&P, where the valuations look pretty full. We look quite decent in some of those stocks.
It's interesting. You mentioned earlier, you spoke about how a lot of advisors are taking clients' money offshore, kind of during the course of last year. Now, if your logic says that actually when the Rand's stronger, this is actually the time to do it. But actually what happens is the opposite. So it's almost the fear of when the Rand is blowing out is actually when money goes versus actually when now they're hang on, it's okay, we want you at 1385, you said, gee, can it go under 13? Okay, let me wait. And so what is your view on do you have a view on the Rand?
Look, forecasting where the Rand's going is very difficult to say. I mean, you can look on a PPP basis and sort of on what is a fair value over time, and then it moves 30% expensive, 30% cheap. And that just depends on sentiment drives at what's going on globally, the emerging markets, the MB spread. And Nedbank did quite an interesting piece a month or so ago, where you look, when it blows out, it tends to go relative to fair value, about 3 standard deviations. It gets 3 standard deviations cheap, and then it tends to recover, and it gets 1.5 expensive. So we over one standard deviation expensive at the moment. So it definitely is a time. If anyone hasn't taken their allowances this year, now's the time you would be taking it off.
That's
I mean, it might strengthen a bit more, but the bulk of the strengthening we think has happened. Still positive momentum, but don't try and be too cute. We're at the same level we were 5 years ago, just to put in perspective. 5 years ago, the Rand was at the same level and you had the interest carry. And I mean, even if you want to go back in 2000, 2001, I think it was, the pound, we're at the same level, because everyone says the Rand so buggered, we're at the same level, 20 to 1, 19 to 1, as we were 21 years ago when we had the Rand crisis. So people forget that. And you think how high our rates are. So your carry trade's been good. So over time, we should just appreciate pretty much in line with the interest rate differential. That's what we've tended to do.
Amazing. But also it's highly tradable, if I'm right to say. So actually, that's part of the volatility. Now this is a really good question, also from Robin. The use of AI in the investor space is becoming more and more of a talking point these days and become a bigger part of our lives. Are you using this opportunity when you construct portfolios? And maybe, Dwayne, how do you use kind of data when you're looking at kind of the SA equity stocks?
So, I mean, right now we gather a whole bunch of data, but it's really the analysts processing it. I mean, obviously we use the normal tools. You can use Excel to look at trends, etc. And we've got one quants guy that looks at a whole bunch of trends, puts it together for us. So that's great. But if you're going to talk true artificial intelligence, I mean, we haven't embraced that at this point. We started looking at it, but I mean, true artificial intelligence, there's very few people out there that have got artificial intelligence as such. There's machine learning, which we've looked at as well. So that would be step one. You would go into machine learning. And there's a lot of interesting stuff out there that we would be looking to embrace over time. I mean, I haven't heard of, I've heard of a few shops in South Africa trying to do it. Very few that I've seen that have actually got it right. I mean, obviously, you know, you've got Renaissance Capital out of the US that's world renowned. And I mean, with a lot of mathematicians, et cetera, that have got it right. But look, it's definitely something I think where the investment will go is fundamental analysts, you know, that complement, let's say, machine learning and bringing those two together. So that you're crunching big data on the one side, but it's being interpreted by the actual fundamental analyst over time. Because there's things that a fundamental analyst that can do that AI can't do. For instance, engage with the management team, gauge their demeanor, you get feelings, engage with different people from different parts of a business, etc. So
that's if you talk about engaging with the management team, now I know, so we're moving on from the questions now. So we had a chat earlier, and I think obviously what's very topical at the moment is the rollout of the vaccine, the COVID vaccine, which kind of really what phase two started last week. I know you guys spoke to the Discovery management team yesterday.
No, Clicks management team.
Okay.
We've also had discussions with Discovery management as well. Sort of Matt, who does our discoveries, quite a few discussions around COVID with them. But I mean, yesterday I was on a call with the management. We had Brian and myself had a meeting with them, and with the CEO, Ivan Saltzman and Stan Gage and rest of the team, and we're just discussing their rollout, how they're progressing, how things are they getting the vaccines. And it was interesting. I think now that the private sector's got involved and reached certain agreements with government, things are starting to move quite quickly. We've only done, I guess, the 500,000 healthcare workers, and then the sort of now 165. So we only, about just under 1% of the population, compared to globally, the rollout, if you look across the world, is 15%. But we're starting to get going now. And Dischem was saying that they reckon with their sites and that, they will within a month will be able to do 800,000 vaccines a month. So that's just them. Now Discovery's also set up. You've got Clicks who's doing that. So, and the private sector looks like they'll probably do more. They'll be able to do at least 50% of the rollouts. So that's all happening. That's quite positive. And then we've seen some comments that they think that by the end of July, we should get 5 million people vaccinated. So that's subject to the availability. We've got the Pfizer, obviously, shots are here, J&J's, which is manufactured by Aspen, a little bit of a holdup, and that's from the PE factory, but that's a decent number. So I think while we've been very slow, behind the curve, once the private sector gets, and I think it's government and private sector need to work together, and Cyril understands that. And I think we're getting to that phase now, so it should be good.
There always definitely feels like, I don't know, there's been a lot of frustration with the lack of rollout if I could say, and then I don't know, recently there feels to be a lot more positive news and people feel a bit more upbeat about it. And we got a street WhatsApp group, and quite a few messages are coming through from the elderly people on our street saying, went for my vaccine, great process, slick, I was in and out 10 minutes. And you could just see that actually the vibe was a lot better, but also, which then talks to kind of momentum and what we were speaking about earlier.
Yeah. Look, there are a lot of people I know have gone in there and been there for 4 hours, but it varies.
Yeah.
I mean, but I think, look, early on it's teething, etc. It's going to get quicker and better. But there've been a few that have gone for a couple of medical mates who've gone and.
But they've got it.
They've got it, after a while. But it's all moving forward positive.
Dwayne, what are the biggest risks to the equity market in the next 12 to 18 months?
So, I mean, the one we would look at, let's start with macro first. So it would be US interest rates. So if you saw a very strong increase in US interest very quickly, that would obviously affect the markets very negative, global markets.
Yeah.
So that would be something we watch. We don't think that's the base case, but it's something to watch. From a commodity perspective, South Africa is doing very well at the moment. I mean, the platinum group metals price is very high. So the platinum miners are doing well. Diversified commodities, iron ore, very high. So that's helping your Kumba, your Exaro in South Africa. So there, what we would be worried about is the Chinese. You can see there's a lot of rhetoric coming out that they're trying to curb commodity prices, plus just a slowdown in stimulus out of China. You know, at the end of the day, 80% of the seaborne iron ore market goes into China. So they're really the big driver behind that commodity rally. So I'd worry about that. And then locally, things that Murray mentioned. So key man risk around Cyril, the restructuring of the SOE, so getting the balance sheet right of Eskom, that's a major thing, because I mean, it's part of the South African balance sheet and other SOEs. And then a thing we've seen a bit of, which is positive, but probably not enough, is just policy certainty. So, you know, what is the new mining charter? When are you going to issue spectrum for the telcos and sort of make it happen kind of thing? And just getting the ball rolling from that perspective. So we've seen some positive movement there, but probably not enough. We would like to see more. And those would be the sort of the high level risks that we watch at this point.
You mentioned SAEs. I mean, the SAA bailout.
Well, I mean, SA is being bailed out, and I'm not going to comment. I mean, there's a lot of emotion around that. Yeah. People are pretty upset. What is positive in that is that we hear that they're looking for an investor to come in and buy part of the airline. Now, that would be great. So you probably put in better governance, better capital allocation. You got a bigger balance sheet. And so that would be a positive, we would think, if you got the right investor to come and invest in the airline.
And then does that seem like a precedent that government can do that with other SOEs?
Well, I mean, that's what they're speaking to, right? So they're talking about unbundling Eskom into 3 different divisions and then looking for private money to come in. I mean, we see now with regards to electricity generation, they started opening it up, and, you know, there's more and more investment, private investment that'll come into electricity or green energy, which is a positive kind of thing. I mean, you could see them opening up something like Denel. There's parts of Denel that are still valuable. There's some great IP there. Maybe you have a private investor that come in there. So that would be a positive kind of thing. So there is a move in that direction. We would probably just like to see a little more momentum behind it.
So also goes that they go together, policy and the SOE kind of structural stuff almost, because it just feels everything's just so slow.
Correct.
Yeah. Which is, and that's I suppose that you're saying is a risk. It just takes too long.
Absolutely.
Yeah. Do you have anything to add to that, Murray?
Yeah, I think for South Africa, I mean, look, global growth very strong, and the commodity cycle pretty important to help us. So China, slowdown in China. So the fixed investment side, they're trying to sort of slow that down a bit. So if you're looking at the next sort of 6 to 18 months, just hopefully the momentum doesn't slow too much. But I mean, we're fairly confident on the platinum side, particularly the supply issues. There's no new supply coming on. So that should keep the prices relatively high anyway. Maybe not quite at the levels we're at now, but that should still be quite positive. But China's pretty important. And then as Dwayne said, the US on global rate, the 10-year rate is quite an issue for markets anyway. Yeah.
Sorry, just a question caught my eye and I feel I have to ask it. How do you feel about investing in crypto? I suppose it's so topical. And then you're saying Bitcoin and they got taken out the last yesterday.
Correct. Yeah. Look, they're still up dramatically from where it started.
As an oldie, let me comment. Don't understand it fully, won't go anywhere near it. But that's me, older. So I'd rather go with the youngster. But we're very wary.
So my feeling, look, I can't value crypto. I probably don't know enough about it, but everyone I've spoken to that has looked at it in a lot of detail can't give me a good reason or a way of valuing how much it should be worth. So I have a fundamental problem with that, because at the end of the day, we're fundamental value driven, bottom up kind of guys. So I think that a lot of it's driven by fear and greed kind of thing. So people get very excited and drive the rallies, and then it starts falling, and there's a lot of greed and people pull back. Look, if you're going to say longer term, is there a space for crypto, or rather, let's call a blockchain? Absolutely, blockchain, the technology is very interesting, and people are doing fantastic stuff with it. I mean, if you're going to ask me, would I invest a lot in Bitcoin? Probably not. I mean, because I just can't value it.
It's also, it's also one of those things where like your social media almost takes over. So you like Elon Musk is able to have a couple of tweets and say, we will take crypto when you buy Tesla cars, and then he changes his mind a few months later, and I reckon he's just messing with the market almost.
I mean, who knows what his motivation is, but the point is that the market can be driven that easily by
and then you also get the sports, some of the American NFL stars who said, no, only pay me in crypto, and again, everyone jumps on that.
Correct.
Have you invested in it?
No, I haven't.
Yeah, well, I had my two kids that I chased them out, and then my sister, who's a teacher, and she doesn't invest in markets. She's got some. I mean, I was saying, what are they doing? Yeah, this was quite a while ago. I chased my two kids out a lot lower down. I don't know what my one sister did.
But that's always the case.
It's scary. It's like everyone's going in.
Correct. With any asset class, people think you work in investment, so you start getting calls when the asset class has really run hard, it got expensive. People always then say, should I buy equities? Should I buy equities? And same with Bitcoin, it runs very hard, and then everyone wants to know about Bitcoin. It's generally, you should be asking the question when everything looks very cheap and, it's been under a lot of pressure. That would be the opportunity.
Another question, a good one. With the private sector, we've always had the governance issues we spoke about very briefly earlier. But are we through those governance issues? I mean, so you think about like the kind of the political guys get a lot of flack for lack of governance and corruption and things like that. Then you get your Steinhoffs and some others. I mean, is there another one coming down the line, or in?
Look, it's very difficult, I think, to forecast these things. I mean, Steinhoff just came out of I mean, with hindsight, everything's quite easy. Everyone lists, this. Not so easy. We saw, EOH was one that as well, how they were manipulating the numbers, what they were doing. Scary what's come out of that. And you're right. I mean, it's been quite disappointing, because I think the robustness of the private sector historically has been unbelievable in South Africa. International investors just thought we were world class, right at the top. So Steinhoff dented at that, a few other mishaps we've had. And I think then people dealing with government as well. So the private sector, well, how do we do business? And you seem to be there's quite a bit of that tends to happen. The listed companies we deal with, a lot of them are big multinationals, the larger banks and that, all pretty decent. But I think in the contracting space and some of the smaller industries, there still is not good stuff that takes place, I guess.
Is there need for some kind of structural reform in the private sector?
Well, firstly, from a governance perspective, every time this happens, the process improves. So from the auditing standards to how asset managers look at the companies, everyone's always improving. So it is becoming better and better. At the end of the day, if people are colluding within a company, it is very, very hard to pick up. Even if you look at audited financial statements, even as an auditor, it's very hard to pick up. So really the question is, the moral fabric of society, and that's what's going to drive it. So it's got to be a cultural issue there, which is hard to change over time. In the meantime, everyone's improving their processes, looking at where mistakes were made and trying to pick up any red flags. Will there be another one? I'm sure there will be at some stage. We just hope we're smarter around it and pick it up earlier. Correct.
I think you make a very good point that, as an asset manager, you are a shareholder in these companies, and you're able to go to the shareholder meetings, and you're able to interrogate the management in terms of what they're doing. Right. And I suppose you learn through what's happened in the past.
Absolutely.
Yeah. No. So we've got 5 more minutes to go. If there are any more questions you guys can send through, we can ask 1 or 2 more. But before we get there, I mean, any kind of final thoughts that you guys would like to just share with the audience? So Murray, you positive, it sounds like?
Yeah, no. Look, we are positive. I mean, look, I think we just caution that, I mean, if you look global equity markets, we've had a very big run on equity markets. And we've had huge monetary and fiscal stimulation that has taken place. The Fed said rates will remain low. So if you look at short rates and the 19 members that sort of voted the FOMC meeting, decide the rates, and you look, it's only in 2024 that the consensus is short rates in the States go up. So basically you've got negative real rates globally. So if you're putting money away in cash, you're losing money in real terms all the time. And investing's all about real returns. So there is no real returns in fixed income unless you go into high yield or you go into Africa, stuff like that, or you come to South Africa. So that's where you can pick up yield. So that environment is going to keep markets, probably keeps markets elevated, and they still go well. But the valuations are full, sort of 20 plus multiples. It's not cheap, but if rates remain down like that, this can continue for a while.
Is there an inflation risk potential on the cards?
That's one of the big things. You see inflation expectation in the States, and sort of where that's projected to be is 2.5%. The Fed is playing it down all the time. That's what markets are worrying about at the moment. Very difficult to call. A lot of smart people forecasting this. Fed seems to think this is temporary, but it is a risk. But I think, as Dwayne said, the key is the US 10-year yield, which is sitting at 1.6. If that gets up to 2.5% in the next 6 months, because people are really worried about inflation, hang on, this is coming, don't care what the Fed says, then market's going to have a correction. But I think that the Fed has been very careful to say we're keeping rates low, but that can change. So I think we think net, we think that the US markets trundle along very modest returns. We think the rest of the world a lot more attractive opportunities. South Africa still has some great opportunities. So in our equity market, we still think there's decent returns, and we think SA does better than the returns from here are better than you would get on the offshore. The only thing now is the rand strengthening. You just need to be quite wary when that reverses, because then maybe that could hurt your returns a bit.
Steve, maybe adding to that. So that's a sort of, there's a lot of macro view that Murray gave you there. But if I just look at when we sit around with our investment team around the table and we bottom up looking at various stocks, it's been very few periods where I've seen so many great ideas and opportunities come through the team. So from a bottom-up perspective, within the South African equity market, we really are seeing a lot of great opportunities that we think will deliver fantastic returns for investors over the next while. And that I find very exciting. So obviously, if the interest rates in the US really spike quickly, that will affect global markets. But over time, the fundamental companies will generate good free cash flow, and that'll drive the valuations and the stock prices over time. So, I mean, there might be volatility in between, but over longer periods of time, we're seeing great opportunities at the moment.
No, that's I think that's, for the listener, I think that's probably that's a promising message. As I say, we read a lot of bad news headlines. But actually, cool. So actually, that's pretty much it. We've come to the end of our webinar. So first of all, Murray and Dwayne, thank you really very much, and thanks for hosting us and having us. Really do appreciate coming into your offices. Just as a close, just to quickly sort of check my notes. I often forget things. CPD process. Remember, if you haven't attended the full webinar, you will get the assessment. Otherwise, it'll be in your inbox. Our next in the room is something slightly different to our normal ones. It's called the Elephant in the Room. It'll be on the 29th of June. And actually be hosted not by myself, but by Max Dupree, who will sit with Annabelle Bishop from Investec and Kim Lings from Stanlib. And there'll be lively conversation about SA's future. So that'll be a good one. Otherwise, guys, thanks very much. Really do appreciate it. And I think that's the end.